Occasionally, I'll get an acquaintance or a potential client in with me for a first meeting, ask me, hey, what should I invest in? Perhaps they'll show me one of their investment statements from where they currently are, 5 minutes into the conversation and say, hey, based on this, what you see here, like what changes should I make? Where should I be investing? And what they're looking for, right, is it's called investment selection. They want to know precisely where should we invest. And obviously, we talk a lot about general investing principles and some of the things that are going to be true across the board for everyone. And a lot of those big picture things that we discuss often on this podcast and in the blogs and videos and all that other things. But at the end of the day, each one of us needs to actually invest in something specific. Right? We either need to invest in companies or in bonds or in funds of companies and bonds and CDs and all these other things. And we talk a lot about the big picture. And at the end of the day, we need to actually select an investment. Right? And so what people are often asking me to do is like, what are those specifics? But we need to lay a whole foundation before we can give any answer other than it depends. Because that's always going to be my answer when someone without any of that foundation laid, without any of that preamble says, what should I invest in? Or this is how I'm invested. How should it be changed? And so we need that foundation before we can talk about anything else. And so we want to cover investment selection. I'm going to cover it next week. And we're going to talk about some of the ways how we should not do investment selection, how we should not be choosing our actual investments, and some of the ways that we should be. But before we do that, we need to make sure that we're all on the same page with that foundation, which is what we're going to talk about this week. And so, if you've been listening to this podcast for a while or watching our videos or reading the blog or whatever else, or read the book, you're going to have heard some of this before, but we cannot understate these things, right? Because there's tons and tons of media out there, tons and tons of the financial pornography network that are constantly going to be telling you, pay attention only to investments. Only pay attention to the investments you're selecting. That's all they talk about. All they seem to care about is which funds are going to outperform and the best rated funds and all these things, and all of the attention, if it's not on the general market itself and on the general economy and whether or not it's going to crash or do well, it's on specific investments and which ones you should or should not be in. And so there's going to be this pull for you to constantly be looking at the exact specific investments you're in and to ignore some of these greater foundational principles. And so we want to come back to it. So even if none of this is new information, if you've listened to everything I've ever talked about, or if you're a client of mine, you will know probably all of these things. But we want to, again, just lay them out succinctly and to make sure that we're on the same page before we step into that investment selection conversation next week. And so what we're going to talk about today is investing order of operations, right? What are the things that we need to do in order before we can get to the point where I can answer, these are the exact investments that you should be invested in, right? So there's 7 aspects, 7 steps that we need to take, the last one of which is investment selection. So let's look at the other 6 first, right? So number 1, order of operations number 1 is we need to clearly define the goal. Order of operations number 1 is the goal, right? We must clearly establish what we're trying to do. What are we trying to achieve, right? Are we trying to fund kids' college? Are we trying to retire with independence and dignity in 5 years, 10 years, 50 years, tomorrow? Are we trying to outperform our friend at the YMCA locker room over the next month, right? What we're trying to do and the goal we're trying to invest for clearly matters in how we would select our funds and do all the other steps. And so we must begin with the end in mind, right? Where are we trying to go? And only then can we answer all of these things. So, again, money is not the goal, and nor is investing for investing's sake the goal. We don't just invest to invest. We invest because we have something out there, a why that we're trying to get to. And if we don't know the why behind why we're investing, then we're not going to be able to answer the how we should invest. So after we've clearly defined that goal and we have that in mind, we then create a plan to get there, right? And so our order of operations number 2 is the plan. A goal without a plan is just a wish. And that statement's a little campy, but it's absolutely true. And a lot of people, they have what they think are goals and they have no designs, no action steps, no orders in order for how to get there. And so we need a plan to actually achieve the goal that we laid out in step 1. Investments and the specific investments we choose will be a component of that plan, certainly, but there's a lot of other things that we need to do first, and far too many people have a portfolio with no plan. And a portfolio is not a plan, right? Almost everyone has a portfolio of some kind. They've got a collection of investments that maybe they know why and maybe they don't understand why they have what they have. But almost everyone has a portfolio of some kind. If you have any investments, any 401ks, Roth IRAs, anything, you definitely have a portfolio already. That's true. But a portfolio is not a plan. And you need the plan before the portfolio. And we do well, again, to always remember that, because most of the focus tends to be on the specific investments in the portfolio rather than the plan. So when the goal is clearly established and the plan is formulated for how to get there, we then fund the plan with a portfolio. And that's order of operation number 3, right? Then we construct the portfolio. And portfolio is a collection of investments that give us the best chance to achieve our goals. Right? There's no guarantees. Past performance of certain portfolios or funds don't, of course, guarantee future returns. And so we can't know. All investing is uncertain. Even investments that purport to be certain, right? Hey, we will guarantee that we'll pay you 3% or 4% or 5% or whatever over this amount of term. Even those things that appear to be certain, there are other factors such as taxes or inflation or other things that can change and make that investment, in fact, uncertain. And so it's always going to be uncertain. So we need to just realize that going in and pick the portfolio, construct a portfolio that gives us the best chance of achieving our goals, knowing that absolute certainty is impossible. And so we're going to look at, what has maybe historically given people the greatest chance of achieving these goals and build it that way, and things that we believe going forward will give us a similar chance of reaching our goals. But we, and so then, before we can select those specific investments inside that portfolio, though, before we can get to that point, we first must determine our asset allocation. And that's step number 4. Order of operations number 4 is asset allocation. So we know the goal. We created a plan to get to the goal, which includes investments. Then we're going to create a portfolio to fund that plan. And the first step in that portfolio is to determine our asset allocation. And asset allocation is the amount of money that we have allocated between various asset classes. Most notably, right, it's our allocation between buying ownership shares of the best businesses in the world, aka investing in the stock market, buying stocks or equity funds. What's our allocation towards buying ownership shares of the best companies in the world versus loaning our money to governments and those same companies, right? Buying bonds, bills, CDs, those kind of things. That's really what it comes down to, right? How much are we going to be an owner of the best business in the world, and how much are we going to be a loaner to the best businesses and to those governments? And absolutely, asset allocation absolutely cannot be done without a goal and a plan. It's just not possible to do it correctly without those things. Of course, you're going to have an asset allocation. You're going to default to something if you haven't done those things, right? And if you've been working for a long time and you've got a 401k and you've never done any planning, maybe you're just dipping into learning about it, right? You have a portfolio, you have an asset allocation, and it's probably the default one, a target date fund or something else which you were just thrust into because you didn't choose yourself. But to do it well, right, to have the correct asset allocation, you absolutely need to know the goal and have a plan and all those things, because when you need the money is totally going to determine what your asset allocation is, right? What's the money going to be used for? What's the goal? If you're going to need the money in 6 months for a down payment on a house or something else, right, we're probably not going to invest that money in Chinese startup companies. Just probably not going to do that. That's not going to be smart. But in the same way, if our goal is to create a retirement income that's going to outpace inflation, outlive us, and outperform others, then having a huge portion of that in asset classes or in investments that barely do better than the cost of living, grow faster than the cost of living, that's just not going to work out for us. We need to do better than that. So depending on what your goal is, how far it is out, the length of that goal, right? We often say around here, retirement is not the goal. When we're saving for retirement, we're not saving for one point in time, but rather that's the midway point, the halfway point in a marathon. We still have 2 or 3 decades beyond that. And so, is it just one specific point in time, like putting a down payment on a house? We only need the money at exact point in time, or are we investing for a range of time, such as retirement or even college, right? It could be a 4-year range of time. So all those things, what the goal is for, what the money is for, the plan, all that severely dictates what our asset allocation is going to be. And that's why we need to do these things in this order. And so if we're going to be investing for the long term, right, we just need to be invested differently for the long term than for short term, right? And for we're going to retire. For a lot of us, we're investing for the day we retire and the 2 or 3 decades after that, and we need to have a big portion in the best business in the world if we're going to do that properly. And so the percentage of your money that is invested in equities is the largest technical determinant of your long-term investment growth, right? The percentage of your money that you have invested in the best businesses in the world in equities is the largest technical determinant of your long-term growth. And that's why asset allocation, once you get in the portfolio, that's the biggest factor that you can look at. How much of those two things can we do? Equities versus fixed income. And it also depends then, obviously it depends on the plan, but it also depends heavily on this overarching caveat, which is your behavior, which we talk a lot about here. But again, if you're new, maybe this is the first time you're hearing about this, that your financial behavior is the number one factor in whether you achieve your financial goals and succeed in investing. Just hands down. It's the number one factor. And it's not talked about enough, right? There's no investment selection we can make. We're going to talk about that next week. What do we actually choose in investments? But there's no investment selection that you can make that's going to make up for flawed financial behavior, right? Owning the best performing fund doesn't matter if you got in at the top and panic out at a bottom. And so that just has to be the overarching theme. We're going to talk about that a little bit next week. And what you'll notice right before this, right, as I said, asset allocation is the largest technical determinant, right? Of all the things that we can measure very easily in all the financials, asset allocation is the biggest portion. But behavior is the largest overall factor in your success. And it's more challenging to measure, right, than historical investment performance, but it's undoubtedly more important, right? And the greater your percentage that you have in equities in the best businesses in the world, the more volatility you're going to have there, the more growth you're going to have, all these other things, the more important your behavior is. But assuming that your behavior is perfect, we've talked a lot about this in other times, so I'm not going to go into it too much now, but assuming that your behavior is perfect, right, likely through the guidance of an empathetic but tough-loving investment advisor, right, behavioral investment advisor, assuming that that's perfect, and your asset allocation is now chosen, right? We've decided based on the plan, all these things, this is the percentage we want in businesses, and this is the percent we want in fixed income. Then we need to examine our diversification within the asset classes, right? So a lot of people use the term diversification to mean like, oh yeah, I'm diversifying between bonds and stocks. That's not diversification, that's asset allocation, right? That's a different thing. Diversification is then inside of your equities, inside of your stocks, and inside of your fixed income, your bonds, CDs, all those kind of things. What is the ratio of those different things, right? Inside of fixed income, what is I've got, 20%, 40% in fixed income. Inside of there, how much do I have in long-term bonds, medium-term bonds, government bonds, corporate bonds, bills, CDs, all those things, right? And on the other hand, in equities, how much do I have in large companies, small companies, growth companies, value, technology, healthcare, like whatever, however else you want to parse it down. That's what diversification is. So operation number 5 is to look at your diversification. You can only do that after you've decided how much you want in fixed income and equities, but then you got to go down farther and figure out how much we want inside of those things. And so, you could determine in your asset allocation, hey, I want 80% of my money invested in the best businesses in the world. Okay. Well, technically you could put 80, all that 80% just in Apple, and you would still be, have the right amount of equities in your portfolio. But that would be dumb. It'd be dumb to have that much riding on a single company that could go broke or could go down. And so we want to diversify, right? And this is not a new concept. If you invest in it at all, you need to diversify, spread out the risk, spread out the growth across multiple different companies, and you want to do that, right? So there's a lot of different company styles we can invest in, large, small, growth, value, etc. There's a lot of different debts we could buy, long-term, short-term, corporate, government, etc. And so we need to decide how much of each of those things do we want to do. But then still, again, so you might think that at that point, then you would be able to choose the exact investments, but there's still one more step in between knowing how much you want in each kind of investment and choosing the exact investment themselves. And that is order of operations number 6, which is fees, right? And fees are a drag on performance, right? If you have a collection of companies that averages 10% and you have a 1% fee on that fund, you'll get 9%. Which is not a huge difference inside of 1 year, but that's a big difference over a lifetime. The difference between 9 and 10% over a lifetime adds up to be quite a bit. Now, fees aren't the only thing that matters. And there's some people that it seems like all they talk about is fees, 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 fees. Get rid of all your fees. Don't pay a single thing in fees. Get the absolute dirt cheapest funds you can get. Manage them yourselves. Don't get any, don't pay for anything because fees are all that matters. And that's not true. It's not all that matters, but it is important. But so, give you an example, right? Which of the following is better? Between two options, option A and B. Option A is investment strategy A charges a 1% fee and grosses an 11% average annual return. So you charge 1% and grosses 11%. Investment strategy B charges 0.1%, a tenth as much, right? And grosses 9% on average. Okay? Which is better? Well, clearly option A is better, right? 10%, right? If it grosses 11, you charge 1, you net 10% is better than 8.9%, right? Grosses 9, charges 0.01, you get 8.9 at the end, right? That's just basic math. So fees aren't the only thing that matters. And I see a lot of public information, especially a lot of books that are aimed at the end investor in particular that say, don't ever pay any fees. Just get Vanguard's total stock market fund, pay 0.02% or whatever it is, and then you can avoid all fees and you're gonna have the best performance. And then in the next paragraph they say, but then because the volatility is so high and you probably can't stay in there and watch your account drop by 40%, maybe put 40 to 60% of your money in bonds, which is gonna average 6%. And so in their attempt to remove fees, they're going to invest in totally different asset classes, which is it's not the same, right? Asset class comes first. How much you have in between stocks and bonds are going to be a much bigger factor, much bigger determinant in your overall growth and your overall ability to achieve your goals than it is fees. That's why fees is all the way down at number 6 instead of at number 4. And so it is important, but it's not as important as some people let it out to be. But if everything else is equal, which it rarely is, but if it is, of course, you're going to want to choose lower fees. If everything else about two investment strategies, two companies, two advisors, two whatever else is exactly the same, choose the one with lower fees, right? Now, that's not going to be exactly the same. There's other things that you need to factor in there, right? And pay attention to, where are those fees going? Right? Look at your all-in fees. Who of all the fees that you're paying, where are they going to? Are a bunch going to middlemen like broker-dealers? Are a bunch going to insurance companies or bigwigs on Wall Street that aren't adding any direct value to you? Or are the fees you're paying, giving you direct value, going to to superior fund performance? Again, maybe it's a little bit more expensive of a fund, but it performs better than these other ones, or has in the past, and you hope it will continue to do so, right? Are they going to, a financial planner who's helping you plan out all of these things and save taxes and plan for retirement and help you manage your behavior so that you can collect on those higher returns of equity? So just, how much fees are you paying and where are those fees going? And are you directly benefiting from paying those fees? Or are they just going out to other people who have their hands in the pie but aren't giving you anything? So those are the 2 points on fees. So you've got your goals, why you're investing. You got a plan to get there. You got a portfolio to fund the plan. You know the asset allocation you should have, the percentage between being an owner of the best businesses in the world and being a lower owner to those companies and to the governments. And we have good diversification inside of those. We have spread it all out. It's not all in one company or one fund type. It's across multiple different kinds. And all else being equal, we're paying the lowest fees possible. Then, and only then, do we get to number 7, investment selection. You've got all those things, you figured all that out. Now, which exact funds precisely should we be invested in? And that's what we're going to cover next week. I'm excited to see you then and talk about it. We'll see you next week. Cheers. I hope you enjoyed that. And if you did enjoy that, you would love being a part of our free membership community. It's called Retire Membership, and you can sign up today completely for free. When you do that, you get a host of bonus and exclusive content that we don't give out anywhere else. For example, you can buy my book, 3D Retirement Income, on Amazon, but if you become a Retire member, we will send you one for free or give you the audiobook and ebook just for signing up. You also get additional bonus content, exclusive content, including Client Corner insights from some of the best minds in behavioral investing, workbooks to go along with our workshops to help you get the most out of it, and more ongoing bonus and exclusive content. Some of this you can't get anywhere else, and so we would love for you to join our community. You can join now at retiremembership.com. Otherwise, there's a link in the description of this video where you can sign up. All we want to do is continue to give you the best information out there so that you can retire successfully and stay successfully retired. So you can go in there, do that on our website. There's also a longer form podcast. I think it's episode 80 that will help explain what it is and what we're trying to do with Retire Membership. But join now for free. Get this and much more exclusive content by joining us today. We look forward to seeing you there, and thanks for watching. Cheers.